So in the interest of time, my name is Euan Marshall. I'm with the International Finance Corporation. We're the private sector arm of the World Bank Group. We've been investing solely in private sector companies in emerging markets since 1956. When we think about investment, we think about it through a commercial lens. So in 58 years, we have never made a loss. We think about it through an ESG perspective. So every investment that we do is screened for social, environmental, and governance risks and opportunities through our performance standards. And we think about it as an impact investment, and I think similar to the gentleman, I think we've been doing impact investments for 58 years and never realized it. What I'd like to do is very quickly take on three things that I think have come out of the conversation. So one is asset class, and I think there was an interesting comment from Mike around the sort of the availability of product. And so I'd specifically like to focus on one asset class. The second, very quickly, is the notion of impact, because that's a thorny, big topic which I'm not going to do justice to, but I'll give you a quick sense of sort of IFC's thought processes around how we think about impact. And then the third issue is product development, and I think that was one of the things that kind of came up earlier on, and I'll sort of speak very briefly to a new initiative that we've done. So we think about fixed income and we think about the behemoth that is the bond markets. But I'd like to take you back to another time. And once upon a time, there was a different asset class in the fixed income world. Essentially, it was loans. Good old-fashioned bank loans. And it seems they may be coming back into fashion. And so over the last little while, we've seen a who's who, including our hosts here, have been sort of starting to recommend again the opportunities for investors to purchase loans. And so just take 2 seconds on loans. And I think they're a very interesting asset class for a conference like this for three reasons. The first is commercial. So number one, we can potentially look forward and think, what do we think rates are going to do? The likelihood is, over some time period, they are going to rise. History suggests that in rising rate environments, loan assets outperform. History also suggests that loan assets are uncorrelated with other asset classes, providing some diversification into a portfolio. And thirdly, and this sort of goes to where, sort of touches on where Henry was talking, one of the things about loans are they tend to be senior in the capital structure. They tend to be a little bit more secured, and so I think one of the terms that Henry used was the loss given default. And so when a loan does default, and they do, generally you are able to recover more capital in a loan rather than a different fixed income class. So there are some strong commercial reasons why loans as an asset class may be of interest. But we're an ESG conference, or an impact investing conference. So loans actually have had a framework for sustainability for a long time. The Equator Principles essentially was set up, I think, almost 10 years ago now by the major project finance houses. And what's interesting about loans are we can covenant social, environmental, and governance performance in our documents. We can actually get people to do what we want. Impact. Loans are still a very important source of financing in key impact areas. So this is taken from Bloomberg New Energy Finance. Renewable energy. Renewable energy is generally asset financed. And how's it financed? Project finance loans. So it's an important asset class in certain subsectors. Microfinance, I think people have talked about sort of on lending. From an IFC perspective, we only focus in emerging markets. So what's really interesting from our perspective is in a lot of the markets we operate, there aren't bond markets. So the financing options for emerging market companies are still the loan markets. And so it's a really important asset class in emerging markets. And yes, we, like a lot of other people, are interested in building the bond markets, and that takes time. But you have companies that are looking to grow, they're looking for finance today. And so the loan asset class as a vehicle offers that ability to generate some returns, to covenant ESG, and to drive impact. So I'm not going to sort of go into great detail about IFC. I think, as I said, our approach is to think about investment through those three lenses. Let me just touch for a second on impact, because I think we had an interesting conversation about impact. And I think impact is in the eye of the beholder. And I think that there are different ways in which you can think about it. I think the way that Andrew positioned this around intentionality is incredibly important. But then intentionality for what? It may be where you invest. It may be the process by which you invest, or it may be what you invest. And so from an IFC perspective, every investment that we make, we have to go to our board, which is comprised of 184 member governments, generally from either development agencies or from finance ministries, that think about how is the World Bank, how is the IFC driving the development agenda. So every single loan, we need to be able to articulate why we're making this investment and why we think it's going to make a difference. That can manifest itself in a number of different ways. It may just be where we're investing. We invest in 105 countries in emerging markets. When we think emerging markets, we're not talking BRIC, we're not talking the next 11, we're talking the 85 after that. And in some cases, it really just is capital. Scarce capital, which will help companies grow. In other situations, it's the type of money. So particularly in the loan markets at the moment, where we've seen regulation, what we're finding that sort of traditional partners of ours are constrained in their ability to provide long-term financing. And this perhaps sort of ties back to some of the discussion we had yesterday around patience and the ability to provide money for the longer term. And so what we're finding in the lending markets are, because of regulation, banks are constrained in their ability to go to long term. So some of it might just be about the instrument that we use and our ability to do something different. And the third, and probably the most common, is, well, what do our businesses do with that money? And so what are the impacts that our clients are having? So in our infrastructure investments last year, our clients reached and provided access to over 50 million people. In our banking investments, they created access to finance for 35 million people. So it's the intentionality of our clients in driving impact. And so as we think about impact, we do think about our clients, and we don't just think about this as social entrepreneurs growing up. That's one approach to driving impact. The other is to leverage larger businesses, to leverage their resources, whether it's human, whether it's financial, and to help them change their products and processes to be more inclusive, to be more sustainable, to be more responsible. And by the way, the great thing about that is that I'm investing in a larger company, which gives me investment opportunities at scale. It gives me the ability to play across asset classes. And so there's a different sort of approach. And I don't think one is right, one is wrong. It's just different approaches to driving impact. So product. And just sort of a kind of a segue into this, I think there was an interesting interjection by the gentleman from FMO yesterday. And I think one of the things that he said was that, look, development finance institutions like FMO, like IFC, have been impact investors for a long time without knowing it. I think we have developed some experience. I think we have learned some lessons. I think we've run through some walls, and I think we've run into some walls. And I think that we do have an opportunity now to engage with audiences like this. I think up till now, we've tended to be a little insular. Oh, we're development finance institutions, and we know what we're doing. And I think that a few years ago when, our balance sheet, we've got an $80 billion balance sheet, and, that was relatively impressive back in the day. Not so much. And so for us to be meaningful and for us to drive change, we do need to partner. And so I think one of the things and one of the roles for DFIs is not just to make investments, but it's to provide platforms and opportunities for others to co-invest. And so IFC on the loan side has had an active syndication platform. We've syndicated about $45 billion worth of loans to third parties over the last 50 years. And we've done that on a deal-by-deal basis. Generally a bank looks at the opportunity, maybe it's a client of theirs, they make an individual credit decision, and they decide to co-invest with us. One of the challenges we found was, is there a way that we can create an opportunity for different types of investors? Maybe investors that don't have the credit capacity that sort of banks have. They don't have either the capabilities or indeed they can't wear the transaction costs of deal-by-deal scrutiny and then managing a loan, which is quite intensive. It's different to a bond. We did a loan the other day, and there were 37 waivers and amendments before first disbursement. So we committed it, then we worked through all the conditions precedent and had to make 37 exceptions before we could actually disperse. So it's a very credit-intense process. So what we've developed is a product that allows a portfolio investor to co-invest with IFC in its entire portfolio. It's not a securitization. We're not selling our portfolio. We're effectively forward syndicating what we do. It's a tracker fund. It's like an index product. And what it offers is for an investor who does want to make an investment at scale and isn't going to make it in individual companies, who does want broad diversification, so likes the notion of being able to get exposed across 100 different markets without having to build the capacities in each of these markets to assess credit, to originate and assess credit. And who is interested, and I think this is really important, who is interested in that double bottom line approach that says, look, every investment is going to be screened for social, environmental, governance, risk, and opportunity. And every investment needs to be able to articulate a development story. And some are clearer than others, but it's a portfolio. It's a portfolio approach that provides that diversified group of investments. It provides, if you will, a blended risk-return profile, because obviously you're diversifying across assets. So we've developed this new syndication program. We have started it, so it is a real process. We have a single investor who has provided a $3 billion managed account. So we're doing this at scale. And it is now a process that we have that is working and that is operational. And we think that it is, for certain investors, an opportunity to get exposure into emerging markets, to get exposure into an asset class that they may not have great exposure in already, that provides some diversification benefits. And it is an opportunity to get that impact investing story.